Welcome to Tech Talk Tuesday. I'm your host, Carla, and with me is my fellow co-host and CMT, David Blake. We are recording one day later this week so that we can cover yesterday's brutal day in the stock market. So it's Tuesday, August 6th, 2024, and we have so much to cover. So I'll jump right into it. David, I hope that you had a great weekend. How are you doing today?
I did. Kind of licking my wounds from yesterday.
Okay, I know that golf tournament was intense for you.
Yeah, that too. That was kind of a slump also.
Yes. Okay. Well, let's get started. Let's take a quick look at last week's, and then we have so much to look at going forward.
Okay, we had last week. We actually started this summer sell-off. We actually kind of hit its stride. We had the semiconductors, especially down 9.7% on the week, and then we had the small cap Russell 2000, which we've been rotating into with the small caps. It was down 6.7%. So that's the tone of the market has changed a little bit because now we're starting to get a little bit more of a slump than what we anticipated. We had the NASDAQ actually fell into correction territory last Friday intraday. So that was something that means it was down more than 10% from the highs. So that was something to take notice of. That's the first correction we've had since going back, I guess, last August, September, when we had that last summer sell off. But anyway, what was going on? We came out with that weaker than expected jobs report, and I think we wrote in Thursday's daily commentary that if we saw an uptick in the unemployment rate, that would be pretty bad for the market, and it was. We only had 114,000 payrolls added in July, and that was the lowest since 2020. And then the unemployment rate went from 4.1 to 4.3, and that was the highest level since October 21. Rates dropped 4% on that news, almost inverted. The yield curve almost inverted on Friday. It did yesterday for a little bit, but now it's still just slightly inverted right now. And basically, what was going on was the jobs report is investors and analysts and all began to think that maybe a soft landing it isn't going to happen, that the Fed is probably behind the eight ball, and they may be behind the eight ball a little bit because a lot of the stuff that they look at seems to be a little bit lagging. So anyway, so this jobs report kind of got people talking about a recession possibly in the works again. As we mentioned, the letter that rate sensitive sectors and defensive sectors were actually higher on the week. That included utilities and REITs, consumer staples, and actually communication services, which is a growth area, but it jumped because of a nice earnings report from Meta Platforms. So that sold off yesterday with the rest of the market. Everything sold off yesterday, so that's no big deal. We also saw the energy sector going down. And the reason for that, despite all the stuff that's going on in the Middle East right now, you have slowing global growth and possible recessions occurring. That's just going to make demand, less demand for oil, and that's causing all the oil stocks to sell off around here. So, it's kind of the great rotation trade that everyone's been talking about kind of came into question as to, whether we're going to have a soft landing and that, we'll start to put money into the cyclicals and small caps and we'll see how the value stocks and that'll the economy begin to grow a little bit slower, but still maintain a decent position as the Federal Reserve starts to lower rates. And the jobs question brought that into question. We'll have to see going forward what happens. There are a lot of analysts that think that the jobs growth was weather related because of all the hot weather and just certain elements going on in July. We'll have to see what comes out here over the next couple of weeks. Now, Thursday of this week, we get another jobs report. That's the weekly jobs report. And we want to see what's been going on there. We've been seeing the initial jobless claims rising for about the last 3 months. I think last week we were up around 250. They were expecting like 220. What you don't want to see is the weekly jobless claims starting to spike up and get up, start pushing 300,000. Because then all of a sudden you're probably going to see more recession talk coming on the table, and we could see more weakness in the market. So, highlights of last week, we did see some strong earnings. We also saw some weak earnings, and so they've been kind of mixed. Guidance is kind of hard, is kind of shady, especially in the growth sectors and stocks. They're not sure how slow the economy is going to be. So that is causing some, you'll see somebody beat their earnings and revenues, and then they say, but we're not quite sure, or maybe they're going to cut back on their forward guidance, and then you'll see the stock going down 7 or 8%. That's a lot of times that's an overreaction, but that's just what happens, we're going on. So at the end of last week, the CME Group FedWatch was now projecting 50-cent cut in rates September, and they projected that about 71% probability that occurring, and that was just at 5% probability just a month ago. So that's really changing. I think right now we have 100% probability of a half-point red Kate cut in September, and then I think that's followed in October also, and some going along like that pretty quickly. I think they're actually projecting now at least 4 rate cuts by the end of the year. I don't know whether it'll be that. It kind of depends how the data comes in. If we are going into a soft landing, you may not see as many rate cuts or as aggressive rate cuts as we do see.
Okay, and how is the technical condition of the market doing?
So anyway, the technical condition of the market, it did deteriorate last week. There's no denying that. We came down 2 weeks ago and we kind of got a little bit of a bounce, and then we sold off late last week with this jobs report. Most of the technical indicators are in negative ground. We were also coming off overbought conditions. I did want to say that one thing that we questions about, and that is, why isn't the SRO, the MarketEdge S&P short range oscillator, showing more of a, why isn't it showing the market oversold in here? And actually, that's the reason for that is basic, as we've talked about this before. It looks at the whole market. In other words, it's looking at the advanced decline lines, which, as this rotation was going on, was not bad. We saw days where the Nasdaq was down 300 points and the AD line was actually up, or when you saw more new highs and new lows. So when you take all that into consideration, the market wasn't getting oversold. I think yesterday we finished around minus 2.8 or something like that. And it's not really oversold till about minus 4.5, and then you start seeing the buyers coming in around, if it gets above like around minus 7, you really start to see some of the institutional players come in and buying aggressively. Now, with that big of a drop, because I think the week before on Friday or something like that, the SRO was still positive, or maybe just negative a little bit. But when you see the SRO drop over 4 points in a day, like that is very rare, which means it could indicate that we're, until we get oversold, we still have more downside to go, because that's only happened in the last 14 years. We've only seen drop like that 4 times where the market, where the SRO wasn't oversold. So again, it was the underlying AD lines and new highs, new lows, that type of thing that was telling us that the market wasn't oversold. And in fact, if you remember last week, I think even with the Dow down like 800 points, down 2%, the AD line was only off about like some less than 1,000 units. So that rotation was still going on, but which meant that the market wasn't oversold at any point. So anyway, so we had a lot of indexes come down. They tested some of the key moving average support levels. Most of them kind of bounced off or crisscrossed over those support lines. We talked about them in the weekly letter here, that you can take a look at some of those levels. That I said you might want to watch these, because if we begin to break these, you're going to, we're probably going down further. And that's what happened yesterday. Well, yesterday was kind of a unique day in the fact that, with that, over the weekend, after they analyzed more of the jobs report, you had a lot more sell orders coming in on a Monday. And then we also had, I wrote yesterday that the yen carry trade was beginning to unwind, which caused the Japan's Nikkei index to sink about 12.4%. That's the biggest one-day plunge since October 1987. And whenever we're talking about market drops, people get a little nervous when you start talking about October 1987. So that got people excited. And then luckily today, we're kind of, people cooler heads are coming around today, and we saw the Nikkei bounce back 10% already today. So that means over the 2 days, we're only down like 2 or 3%. So that's not bad. We're also seeing the U.S. markets jumping back here today, which is strong. Now, yesterday I mentioned that there was some speculation that the Fed would come in before the open and actually cut a quarter rates, cut them a quarter. Well, when the July ISM services survey came out, and it was above, it came in at 51.4 versus the 48.8 the previous month. So it was improving. That meant that the economy was still, growing, and that was an expanding number. So that kind of took that off the table, and that kind of got some traders a little bit upset with the market, the Federal Reserve. So that also contributed to the sell-off. And then, at one point, I think the Dow was, or the NASDAQ was down 1,200 points. That was a 7.4% drop. So they were just selling across the board. Every sector was down. The VIX spiked sharply higher. And again, it was an ugly day. And you kind of expected when you get a day like that, you're going to get bounces. And we're getting that today. I don't know that you want to be jumping in. Just the fact that, when you have something like that, there's a lot of technical damage to different things. A lot of start to get some margin calls, things like that will also induce more selling. Now, the week coming up, I just mentioned we had the ISM services PMI came out better than expected. That was good. We have a ton of earnings coming out again from some of the heavyweights. Not so much the big tech; they're all done, but we will still get some tech earnings. In fact, last night we had Palantir, one of the AI plays, came in. They beat. It's up about 12% today, which is nice. Caterpillar, I think, surprised to the upside today. But Thursday, again, you want to kind of watch this Department of Labor release on the initial jobless claims, because if we see if it keeps rising, that's going to be a little bit showing that the Fed is behind the eight ball. I don't expect to see a big drop in it. I don't think anybody does for that. So, with the unemployment rate of 4.3%, highest since 2021, we need to let some economic data points hit the market before we decide that this is all over or that it's time to jump back in the market. I think we right at this point, we just kind of stay on the sidelines and see what happens.
Okay, you mentioned the yen carry trade. Can you briefly go over what that is?
Yeah, it's just to make it real easy. Okay, if you have the yen is weak against the US dollar, and rates are almost at zero in Japan, like 0.5% or something like that. And ours are up here around 4.5% or 5%. You can borrow the yen to buy to get dollars and buy and get a higher interest rate over here. And so you carry the money from one side to the other, to over here to that side, and then you make the extra percentage, and you can also speculate in the market, that type of thing, and you'll still be making money as you're getting free, not free, but you're making money on the money that you're borrowing, actually, because of the difference in the yields. So then when Japan comes in and they raise their rates, that's going to strengthen the yen, which means instead of getting, I don't know, 120 yen for every $100 or whatever, you might only get 105. So by the time you pay commissions and transaction costs, it's no longer that big of a profit that you risk, borrowing that money to go into the market, or, just buying treasuries to make the money. So then they unwind that and they sell the treasuries. They get out of some of the yen comes back, and then that's why their market goes down.
Okay, thank you for that explanation. So, one of the big elephants in the room, the volatility index, or also known as the VIX, I thought that the jump that we talked about in last week's episode was notable when it jumped from 14 to 19 at one point. But that doesn't even compare to yesterday's wild ride up to 65 at one point. Yikes. Has the
Yeah.
VIX ever seen such a wild jump up and ride in just one day before?
Yeah, it actually has. Back in 2020, when the pandemic came, it actually got up to 85. It was trading around. It was really low going, because we had been making new highs, I think, in that January 2020. And then when the pandemic started to come around, it was like, holy mackerel, this is, the world's coming to an end here. And you were actually trading with the VIX down around 11, 12, kind of like, even lower than where we are right now. And it jumped all the way up to 85. And what that is there's two things that happen with that. Number one is it's just people went out and they're leveraging options to get out. They want to buy puts on the market, and the puts become ultra expensive because if I have to write a put and I'm seeing the market going down 500 points, if I'm selling you the put, the premium on it is going to be I'm going to skyrocket it. And some of these things are done with obviously with computer trading and all that. Computer just knows that I need to buy when this happens, and that's why you'll see these spikes. But like I say, back in 2020 at the pandemic, we got up to 85, which is crazy. But this was notable. I mean, back 2015, we had something going on that summer. It got up around 55. 2018, I think that was around that election. No, 2016 was the election, somewhere around that time period. That we saw the market start to go down when worried about Trump at first, and we saw the market fall down and come right back up. So that that was a big move yesterday because again all of a sudden you go from we're staying in this market, we're rotating in different sectors to we're going to a recession. And recession is not good for small caps and technology or growth stocks. We need to get out. So it was an exaggerated move. In fact, we came back down to close at 30, 36 or 38, something like that. So they cut it way back down. But yeah, and that's why some people will trade options on the VIX or they'll buy double or triple leveraged things on the VIX because when things go bad, you can get something going from 12 to 80 in a day. That's a hell of a move, and they'll keep that. Some traders are looking for that a couple times, once or twice every couple of years to make some big money on that.
Okay. That's definitely helpful to know. And you also mentioned in yesterday's daily comment, which can actually be found on the homepage, to keep an eye out for bull traps and not to get caught in one. Can you elaborate on that more?
Yeah, just kind of like I mentioned that last 2 weeks ago. When you have a sell off, a lot of times people, as the news filters back in, you have a lot of people go, "Oh, well, that wasn't that bad. I need to, I need to buy that. I've been wanting to buy this stock. I've been going back in," and you'll see a bounce. Some people call it a dead cat bounce sometimes, but then if you jumped out of something here on the yesterday or on Friday, and all of a sudden today you see the market jumping up, you go, "Whoa, darn it! I sold it. I need to be back in there because I love Microsoft or I love Apple." And then all of a sudden you jump in at where it's down $20, now it's only down $12, and you're jumping in. You go, okay, I'm back in, and then all of a sudden starts heading the other way. Those are called bull traps because but the market goes up and all the bulls jump back in, and then bears come in, they start shorting the market again, and maybe more data comes out and the market starts heading lower again, and then all the people that jumped in for the second time bulls, they're not they got trapped in a little bounce on the market, and now all of a sudden they're losing money a second time. Then they've got to try to jump back out and sell what they just bought, and they're going to be selling that at a loss. And again, that just induces more selling, and it's something that happens often. That's why I said our CTI, our cyclical trend index, is still negative, and we're gonna be negative on this thing for a couple more weeks. I think that you may at least go down, which often happens is when you have a big sell off. There's often at times that you may go down and get close to where those levels were, and then a lot of investors and institutional traders will watch that level, and if it holds, okay, then they're going, okay, if it holds for a day or two, then that's when they begin to come in here and start buying again. I did want to say that if you are looking at thinking, well, it is down here pretty good, I do want to look at something to buy. I looked at some charts. We can go to them, I guess. Yeah, we can go to the charts right now.
Okay.
Now, when you see this, I looked at some of these, and as far as some of the real growth sectors right now, like technology and consumer discretionary, and even energy, which you need a good, healthy economy for these to go. You can see like yesterday where they fell down 200-day moving average. Technology there went down below the 200-day moving average. At today's bounce, it's just trying to get up there. It's still below it. Same with energy and consumer discretionary. And then you have other more cyclical sectors like financial and industrial and even materials. They're kind of hovering around the 100-day moving average. They don't want to, they've had some good buying going on in there, but they want to, it's still not an area that you really want to be going aggressively into. Now, go ahead and pull up XLP. Okay, you see this thing here. Okay, it came down yesterday to the 50-day moving average. We're bouncing today. If we go into a recession or a slow growth period, let's just say the Federal Reserve is behind the 8 ball here. Okay, you're still going to need groceries. You're still going to go to the drugstore. You're still going to be buying, your regular household, Procter and Gamble's, your toilet paper and paper towels, that type of stuff. Those you're still going to be doing that whether the economy's in the gutter or not. Also, XLV. Look at that. I mean, this is healthcare. Okay, you still got to go to the doctors. It came down yesterday to the 50-day moving average. We're bouncing today. Now it may have a little bit of a little struggle because you don't have the big dividend that XLP does, but you still have to go to the doctor's office if you're sick, and you still got to get your prescriptions, that type of thing. So it's not going to feel the big sell off like you saw here. Let's look at XLU. Okay. Again, when we were just making new highs on Friday in utilities and also REITs, and that's because I mean you're not going to shut your power off here, especially in this summer heat. You're going to have rising power bills. In fact, going through this, and if we have a cold winter, you're going to have rising power bills there. You got to keep the lights on anyway, and the utilities pay a big dividend. As rates are going down and the economy is slowing down, you want to own some of these rate sensitive sectors and defensive sectors because you're going to make more money on the utilities. And as rates begin to get cut more and more, 6.5 or 7% utility dividend certainly looks better than maybe a 2.5, 3% CD rate or something coming down the line. And then XLRE, there's some troubles with XLRE and the fact that there's some real estate speculation that has, is the commercial real estate coming back or whatever. But as you see, the Friday before, it also made a new high because the REITs are there. Hell, you can find REITs trade paying you 8 and 9%. So do I want 8 or 9% with something that's near an all-time high, or do I want to go ahead and speculate on some small semiconductor stock that is only doing 500 million a year in revenues and doesn't pay any dividend? I think at this stage, while you're watching what's going to happen over the next, say, 4, 5, or 6 months, and you also have the election, which is causing this time even more concern probably than they have in some of the past. So I expect to see the market volatility around, but we are going to see probably the Federal Reserve get a little bit more aggressive on cutting rates, and these interest rate sectors and defensive sectors will outperform. And if you're going to have some money in the market, that's where you want to be. And then because it takes a while for these rate cuts to work their way through the system. If you cut in September, you're not going to really start to feel that in November. So you're thinking, okay, well, now we're in August to say October, November. That's 3 or 4 months. A lot can happen to the economy in that thing. The job rate could go up to 4.5, 4.6, something like that. And that, so you don't want to speculate that everything's going to be going right up just because we start to cut rates. And in fact, if you go into the archive of the weekly market letter, show where the archive is.
Okay.
You go down right there. Okay, if you're looking at maybe what happened on a certain day in the market, or for the week, going back a couple of weeks, I think it was 3 weeks ago, in the weekly market letter, I wrote a little piece that said that over the last 9 times that the Federal Reserve has cut, so you can you hit that and you can figure out go to the one from 3 weeks ago, I guess the 19th. And let's go down to the summary and keep going lower, lower, lower. There we go. right there. That the top paragraph there is almost hidden. Okay, over the last, this is from Meter Investments, from Joe Bell, and he did some research on here that over the last 9 initial interest rate cuts, more than half the time the S&P has dropped on average 20.5%. Right now you go on TV, you'll see all the talking heads going, "Hey, interest rates are coming, market always goes up." Well, it doesn't. And on that, more than half the time it goes down. But the good news was 6 months later, the S&P has returned on average about 3.4%. So if it does sell off, you go on. And he also went on something about if PE, forward P for the S&P 500 is above, I think, 18, that's usually when you start to see sell-offs coming in. So that's just something you want to kind of watch in here. So it's not always just the fact that, oh, we're going to cut rates, the market needs to go up. That's not the case. And especially if we fall into a recession, that's you're cutting rates for the wrong reason. You're trying to catch up because you've already waited too long. You hopefully the Fed could come in here and start cutting before we actually fall into a recession. But that's coming more into question after last Friday's job report. So we'll kind of take it from there. I'm not going to step in. Like I say, the CTI stays negative for a couple more weeks, and I think you need to see the market bounce around here a little bit before you start to take a position. However, I would take something like a Microsoft, where you can go in and look at the charts and maybe find the 200-day moving average or a place of previous support where there's now could be resistance, and maybe you put some buy orders in, some limit orders in, and say good to cancel. I'll leave it in here for a month or so just in case we get another one-day drop like yesterday. I might be able to pick up some real bargains.
Okay, well, David, I hate to cut you off, but we are actually out of time for this week's Tech Talk. We want to thank you to all of our listeners for tuning in, and we will catch you guys again next week.